Okay, reminder again, your second quiz is on Monday, first 30 minutes of class, so don't be late. I will be giving the same remote option that I gave on the first quiz, that if you cannot make it physically here for whatever reason, you're in a different part of the world, obviously I'm not talking to you, the people are watching on Zoom, or you have some physical constraint. Now, I will set up a Google Sheet just like last time. Please do sign up by Sunday night. The reason is very simple. There's no automated mechanism by which the Google shared spreadsheet somehow magically pop. I have to actually enter your names individually into Brightspace for you to be able to take the quiz. So if you're all signing up between 1:30 and 2 on Monday, I don't have the time to enter your names in. I mean, last time, I think there were like 3 or 4 people who signed up in the last 20 minutes. I can't pull that off. So if you're going to take the quiz remotely, of course, if there's something, an emergency that occurs on Monday where you, it's okay. Just let me know and I'll see if I can get your name on. But I'll give you a chance to sign up if you want to take it online. But it's got to be in the same 30 minutes. So it's not a remote whenever you want it. It'll be between 3:30 and 4 on Monday. The other reminder, of course, is your valuation projects. If you're going to send them in, get them in as soon as you're done, right? As I said, the Friday is a loose deadline. If you can get in by Friday, great. If you can get it today, even better, tomorrow. But I will try to return them as I get them. But by Friday, that number might be built up that it takes a little while. So today we're going to continue with our talk of discounted cash flow valuation. There might be a few things we talk about today that could alter the way you value companies. So I'm going to start with our usual start of the class test, and I'm going to throw a few issues at you. Now, today we might get to valuing emerging market companies. And one of the concerns you have when you're valuing an emerging market company, not just, but especially emerging market companies, family-run companies, is weak corporate governance. You've heard that term thrown around, weak corporate governance. So let's say you have an analyst who's valued the company using a discounted cash flow model. And that analyst has valued a company where the corporate governance is weak. You don't think you have much power. Should you be attaching a discount to the values of companies with weak corporate governance? First, is weak corporate governance a bad thing for you as an investor? Absolutely, right? And what does it do? What is the problem with weak corporate governance?
Kind of like one of those kind of like potentially. I mean, that's not the only thing.
But if you boil it down to basics, what does weak corporate governance mean to you as an investor?
Well, then you might not.
No, that's the outcome. No.
Uncertainty.
Uncertainty could also be an outcome. It means you can't change the way the company is run, right? That's the bottom line. That's what corporate governance ultimately, if you boil it down to basics, means you can change the way a company is run. And if you have strong corporate governance, you get a chance to change management. Weak corporate governance, you don't. So let's play a little game. Let's say you have 2 badly managed companies. One with really strong corporate governance. What does that mean? They're incorporated and trade in the US, activist investor, no insider holds a large stake. They don't have 2 classes of shares. An activist investor can take a position in the company if he or she chooses to. And the other is a company where weak corporate governance is not just weak, it's dead. Why? Because it's in the wrong part of the world, right? In Russia or China, there's actually almost no corporate governance you can talk of as a shareholder. It could be because they have 2 classes of shares, it's a family-run company. Exactly the same. So the numbers look the same. They're both badly managed. So you're going to value the badly managed company with really good corporate governance. And I'm sorry, what's your name? Helena is going to value the company with really strong corporate governance. So let's start with you. You sit down to value this badly managed company. What does that mean? Its margins are low. The returns on capital are below the cost of capital. But when you do evaluation, what are you going to tend to do because it's got strong corporate governance? Well, you can also change the company, right? You can say the margins are low because the management is bad, the returns on capital are terrible, but management can be replaced. So in your spreadsheet, you're going to move the margins towards industry averages, the returns on capital towards cost of capital, because you're saying, I won't let this company continue to destroy value. So your discounted cash flow valuation will reflect expected change. But when you value your company, the company is badly managed and badly run. The management knows that it's badly managed and badly run. They just don't care. You know what you're going to do? You're going to leave your margins at terrible margins, well below industry averages. Not that they're not making money. They're not making enough money, but they don't seem to care. You might leave the return capital below the cost of capital, not just for next year, not just for the next 5 years, but in perpetuity. Remember, in stable growth, I'll let you set a return on capital. This company might be so badly managed that these guys will never see the light. They will continue to demand 5% returns when they should be demanding 8%. Your discounted cash flow value is going to be dramatically lower than her discounted cash flow value, which means you've already discounted for corporate governance if you've done your discounted cash flow valuation right. So if any of you are valuing companies where you see bad numbers and you're fixing them in your spreadsheet, which you're almost trained to do, right? Improve the margins to industry averages. Get the return on capital equal to the cost of capital or higher, but you are assuming that there is decent corporate governance, and that might get you into trouble in a company where that doesn't exist. Let's move forward. Let's talk about R&D. Remember, we made that song and dance about R&D moving from pain in the neck, if you think about it, right? And what does it do? It changes the operating margins, it changes the reinvestment rate, but it doesn't change the free cash flow to the fund, at least for the most recent year, because all you've done is move things around. So let's say you have a pharmaceutical company. You valued using traditional accounting statements, which expense R&D. So you take their income, the accountant reports the capital. So essentially, you act like R&D is an operating expense. You come up with the value per share. Then you take that same company and you capitalize R&D. Why? Because you invested time and energy learning this process. You don't want to waste it. You capitalize R&D. It's going to change your operating income, change your invested capital, change your reinvestment. My question is about the end value per share that you get. Will your value per share, or what will happen to your value per share for that company when you capitalize R&D? And I'll give you the possibilities. It might have no effect. It might increase value, might decrease value, or it might increase or decrease value depending on the company. Let's start with the one choice we can take off the list. Which of those 4 choices can I take off the list right off this? If our capitalizing R&D has no effect on value, why were we wasting our time doing this in the first place, right? So clearly that's not a choice, because if it were a choice, we wouldn't be wasting our time doing it. So the real question is increase value, decrease value, or potentially have either effect depending on the company. Let me provide kind of background so you potentially can come up with an answer. What are we doing when you capitalize R&D? We're treating it like a capital budgeting project. We're saying, no, it's a project that a company takes when it spends money in R&D. In general, when companies take projects, can they be good projects? Sure. Can they be bad projects? Absolutely. When you capitalize R&D, you know what you're doing. You're holding R&D up to a test saying, is this company doing good R&D? The answer is yes, capitalizing R&D will increase your value. Later in this class, I'm going to show you what happens to the value of Amgen. When you capitalize R&D, the value jumps almost 50%. Why? Because at the time that I valued Amgen, its R&D was paying off in new products and new drugs and high growth. At the same time, I valued Merck and I capitalized R&D. And when I capitalized on R&D at Merck, I dropped my value 20% because leading into the valuation, Merck's R&D had become a value-destroying machine where they spent billions of dollars and no drugs to show for it. So when we capitalize R&D, the consequences can vary depending on the company. And that's exactly why we do it, is to get a sense of which companies should be spending more. Now, keep your eye on what's coming out of DC, because there is talk now of, at least in the Biden 2023 budget, that they want to put constraints on companies buying back stock, right? There's a whole debate to be had about stock buybacks. Some good reasons, some bad, reasons for, no, but they want, and one reason I heard yesterday was Mark Warner, who's senator from Virginia, said, well, we should stop buybacks because companies should be doing R&D. Okay. Will some companies benefit by taking the money from buybacks and doing R&D? Absolutely. But will some companies be destroying not just value, but be bad for the? Absolutely. There's nothing good, inherently good about R&D or innovation or any of that other stuff. Because I've seen a lot of money wasted on R&D that has nothing good that's come out of it other than paying it's a make work program for scientists and researchers. That's good. We don't want them unemployed. But this notion that R&D is always a good thing, just let it go. One final question. Let's say you're valuing a distressed company. Why? What makes it distressed? Its revenues have been shrinking, its margins under pressure, and it happens to have a lot of debt. So what's the sword hanging over this company? Lots of debt, revenues are shrinking, the company could go bankrupt. So you put in, so I give you this company to value and you follow the script. You fix the company on your spreadsheet. You know what I mean by that, right? You make the low margins into steady state, you bring the debt ratio down, and on a spreadsheet, you make it a nice, healthy company, give it a big terminal value. You come up with the present value, come up with the discounted cash flow valuation for your company. Let's say you've technically done everything right in your DCF. Is the value you're going to come up with for this company going to be too high relative to its true value or too low? Or put differently, is there something I'm missing when I'm doing a traditional DCF value with a distressed company?
Does it have to do with securing funding?
That'll secure, it'll survive, right? Whether it secures funding. I am making the assumption that distressed company, because if they don't survive, there's no nirvana, there's no terminal value. I'm assuming that they will survive. When there's a real chance, they will not. The response I usually get is, why don't we use a higher cost of capital for these companies? It's not going to work. A cost of capital was never meant to deal with this kind of risk. What kind of risk? Discrete risk, truncation risk. Risk like nationalization risk, you can't capture in a discount rate. Today, we're going to talk about what to do about companies like those, because your DCF value, even if you do everything right, will be too high for the company. Today, for Russian companies, that's basically what you're going to find. If you do a traditional DCF value, the value will look too high, the stock will look undervalued. But before you make that final buy judgment, there's something else you need to bring into the equation. So let's kick back to where we were in the Amazon. I left you with those projections for revenues and margins. Remember that page? So we just want to review that. So basically, it's best that you don't see people's full video because something embarrassing happens and you don't want that to be on the big screen. So the slide I left you with, I showed you my revenue growth assumptions. And I think I was pretty open about the fact that I don't have the story for Amazon. I have my story for Amazon, where I projected it becoming the 6th largest retailer in the world with retail company-like margins. I also pointed out what happens to taxes, how I'm using the NOLs to shelter myself against taxes in the near years. And then when it runs out, I pay the full tax rate. Let's move to the next big lesson I learned when I was valuing Amazon. If I give you a young, high growth company to value, some of you are valuing young, high growth companies, you get excited, right? It's a young, high growth company, comes with great pedigree, grew 80% last year. And sometimes that excitement leads you to say, why can't I use a 25-year growth period, 20-year growth period, 30-year growth period? And I've talked a little bit about why I stop at 10 years. But I'm going to add to that warning. Even if you have a really high growth company, growth doesn't last that long at most companies. I'm going to show you one of the most depressing graphs I've ever seen. Thinking about growth. It's actually a study that looked at companies going public. Now, normally companies go public at the peak of their growth trajectory and times are great. So what this study looked at was the revenue growth rate at these companies relative to the revenue growth rate of the sectors they were in. say, a young, high growth steel company that goes public, you compare the revenue growth rate to the revenue growth rate of the sector. 1 year after they go public, these companies have revenue growth rate 15% higher than the sector. You say, there, that's why I bought this company. You track these companies 2 years after, that growth rate difference has dropped to 7%. 3 years after, the growth rate difference is down to 3%. And by the time you get to year 5, you can't tell these companies apart from the competition. Growth fades really quickly at most of these companies. Why do you think that happens? What is it about this process that makes growth fade so quickly? One is that they're scaling up, but also the fact that when you grow well, when you grow at a high rate, people notice you, right? Hey.
Oh, competition.
Well, when people notice that you're doing well, they say, well, what are they doing? Let's produce something similar. If any of you are entrepreneurs, and many of you have plans to be entrepreneurs, and you start a business, the question I would have for you is, not what are you going to do if things go badly, but what do you plan to do if things go really well? Right? In the next 6 months, your product takes off. The question I'm asking is, when your product takes off, I can almost guarantee you that there are other companies, often with deeper pockets, are going to come into this market. What have you done to keep the competition out? And you say, if your answer is, I'll think of that when that happens, I'm not going to give you a growth rate that lasts very long. So when you think about growth for your company, don't get too excited about near-term recent growth because it can fade very quickly. So the question you need to ask is, what is the competitive edge of this company? What's going to allow them to continue growing? And try to isolate what that is. And if you can't find anything out there that is special about the company, bring the growth rate down much more quickly. Now, when we talked about growth for mature companies, we drew this very strong lesson, right? If you want to grow, you have to reinvest. And we tied them together with that sustainable growth equation, which means if you want to grow at 4%, your return on capital is 10%, you have to reinvest 40%. Somehow, people who learn that lesson, when they look at young companies, seem to completely abandon that lesson. It's true, you can't use a sustainable growth equation to get the growth rate for a young company because your return is negative, your reinvestment rate is tough to compute. But the basic lesson still applies, right? If you want to grow, you have to reinvest. The sales to capital ratio operates as the mechanism to bring that in. So I'm going to talk a little bit about the sales cap because I know for many of you, as you're valuing your companies, this is the one area where there's actually very little direction out there on how to do this, right? Growth and margins, we talked about what to do. How do you get a sales to capital ratio? So I'm going to use the Amazon example to kind of illustrate how the sales to capital ratio can be set and reset. And I'll explain what the and reset comes in. In my initial valuation, I assumed that Amazon's sales to capital ratio was about 3. It's at the, I think, the 75th percentile of retail companies. Why? Because I think that, you know, and remember, the higher this number, the more efficiently you're delivering growth. So I gave them the capacity to deliver more revenues in the typical retail firm. And the story I'd have told is, look, they're an online retailer. They don't need this leases and brick and mortar and all those costs. They can grow much more quickly. That 3 sales to capital ratio allows me to get the reinvestment. Every year I take the change in revenue and divide by 3. It's as simple as that. And I said this before, and I want to reemphasize that. That reinvestment number includes everything. It's net capex, change in working capital, acquisitions, R&D, it's all in there. I use the same sales to capital ratio over time. Do I have to? Not necessarily. I'll tell you a couple of stories where your sales to capital ratio could change over time. If you have a business where you potentially can have economies of scale on investment, platform that gets easier, networking benefit, it gets easier to grow as you get bigger, you might start with a low sales to cap ratio. And as you get bigger, your sales to cap ratio could actually increase because you now can deliver more growth for $1 investment capital. It's got to be a very unique kind of company, but maybe that's platform companies often have that benefit. Here's another example. You're valuing a manufacturing company. And I'll make it specific. When I was valuing Tesla in 2020, they just finished up their Shanghai plant. Nothing had come out of the plant yet because the plant had just been finished the last month. So when I valued Tesla, I gave them a high sales to cap ratio for the next 3 to 5 years. Do you see why? because they built the plant. It has a capacity to make 200 to 250,000 cars. For the next 3 or 5 years, their growth in a sense can come with very little new capital investment because they've got the capital. So if you have a company with excess capacity, one way you can reward them is you can give them a high sales to capital ratio up front. And then after you've used up the capacity, you got to go back to some steady state industry averages or what this company used to have before. So the sales to capital ratio becomes this lever you adjust. But whenever you value companies with revenue growth and margin and sales to cap assumptions, there is this danger that you can be creating what I call fairy tale companies. Companies that can exist only on spreadsheets because there's no mechanism keeping you from going off the tracks. There's actually one mechanism that's been built into the spreadsheet that I'm going to talk about, that if you look at, you can get a sense of whether your sales to capital ratio is a reasonable one. We don't think of it this way, but when you put in reinvestment to get to free cash flow to the firm, we think of it as what you reduce your earnings by to get to cash flows, and that's technically true. But you know what that reinvestment also serves as? It becomes the delta in your invested capital that year. So when I have an invested capital of $1 billion and I reinvest 150 million, my invested capital next year will be 1 billion plus 150 million. It's an algebraic truism because that's how invested capital builds up. Here's what I did for Amazon. Their existing invested capital is 487 million. That came right off the balance sheet. Book equity, book debt, minus cash, the way we do. Every year that I reinvest, in year one, I reinvest 559 million based on the sales cap ratio. But if that's my reinvestment, my invested capital at the end of year one will be 487 plus 559, which is 1,045. So each year, I take my reinvestment that year, add it to my invested capital, and I get an updated invested capital. You're saying, what are you going to do with that? That's my invested capital. In the previous 2 pages ago, I came up with my estimates of after-tax operating income based on my margins and what I think will happen over time. So if I take the after-tax operating income and divide by invested capital, remind me again what I get when I divide after-tax operating by invested capital. When I take net income and divide by book equity, I get return on equity. I take after-tax operating income and divide by invested capital, I get that return on invested capital. Remember that number we fixated on? I now have an imputed return on capital. Why imputed? Because I didn't actually estimate a return on capital, but because I estimated reinvestment and I estimated margins, I am implicitly coming up with this return on capital. So let me complete the story. The case of Amazon, my return on capital starts negative for obvious reasons. And based on my reinvestment and my margin assumption, it ends up at about 20%. Here's the question I had to ask. I've built this company with a 20% return on capital. Am I comfortable with that number? In the case of Amazon in 2000, I said, I'm okay with it. And here's why. The average return on capital for more mature retail firms was about 18%. I thought Amazon was a little better. And the cost, if you remember, the T-bond rate was 6.5%. So we're talking about a time when cost of capital 11, 12% for companies. I said, I can live with 20.45%. In other words, I can live with my sales to capital ratio of 3. I'll tell you what I would not have been comfortable with. If this return on capital had been 200.39% in year 10, what's my spreadsheet telling me? It's not even telling me, it's screaming it at me. What is it telling? What is it screaming to me? You're not reinvesting enough, right? And if I'm listening, what can I change to fix that problem? What's the one lever I have to decide how much you reinvest? I can go back to the sales to cap ratio and say, I'm not reinvesting enough. So should I lower it or raise it? Got a 50-50 shot, go for it. You're going to lower it because that'll mean more reinvestment. And if I make 3 into 2, my 200% might become 75%. I might have to look. In other words, this will allow you a feedback loop where you can say, well, you know what? I'm not reinvesting enough. In contrast, my return on capital in year 10 was 2.39%. I'm reinvesting too much. If you look at the bottom of the valuation output worksheet that you have in my Ginza spreadsheet, the very bottom line is I've computed this imputed return on capital for your company. Most of you probably haven't even looked at it, but maybe you might want to take a look at that to see if you've built a company that is actually a plausible company. So I'm not saying there's anything you automatically have to do, but it's good to know what kind of return on capital you're giving your company as you go into steady state. Now, I'm going to go back to your original valuation and show you something. See my cash flows for the next 5 years, next 6 years? They're all big negative cash flows, right? What am I telling you when I show you this discounted cash flow valuation? That not only will Amazon have to raise capital in years 1, 2, 3, 4, 5, and 6, but that much of it has to come from equity. Where did I tell you that much of it is coming from equity? What part of this valuation gives away that much of it is coming from equity? See my weight on in my cost of capital, it's 1% debt, 99% equity for the first 5 years. So I don't even have to say it. That ratio kind of tells you that almost all of the fresh, which means they have to issue shares in year 1, year 2, year 3. This is actually the start of the class from last session, but let's nail it down. So my share count at Amazon is going to increase over the next 6 years if my cash flows are right. You're saying, should I be adjusting my value per share for this expected dilution? And I think the answer we came up to when we looked at that start of the class was, you don't have to. Does anybody remember why? Why don't I have to adjust the share count for expected share issuances in the next 6 years, even though I'm pretty open that they have to make issuances? My value for Amazon, if I take the present value of all of my cash flows, is 15.2 billion, right? Just as an exercise. Check out what that value would be if instead of using the free cash flows, I'd set the free cash flows to 0. In other words, right now I'm discounting those negative cash flows and the positive cash flows to get to 15.1 billion. Without those 6 years of negative cash flows, my value for Amazon would have been 20.5 billion. So think of what I've done. I've taken the 20.5 billion, I've knocked it down 25%. Why? Because I have negative cash flows in the first 6 years. Now, what am I going to do to cover those negative cash flows? I'm going to issue shares. But if I now take that additional share count and put it into my denominator, I'm actually double counting. I've lowered the value by 25%. I'm going to increase the share count. That is the double counting I'm talking about of not adjusting for share count. It's a blessing in discounted cash flow valuation that it happens. But you want to be very clear about why it happens, because somebody's going to push back saying, why aren't you adjusting for share count? Take them through the process. The easiest way is to take out the negative cash flows and show what the value would be. So this is how much I'm already discounting. That is the dilution effect. What about the options? Well, there's a huge option overhang at Amazon, right? Because they've been giving these options. Of course, you should worry about it. What's worrying about it going to do, though? So what I did was I valued the options as options. If you remember, 2.8 billion. I took it out of the value of the equity saying, look, that's how much these options are costing you. And I lowered the value per share to $35. Without considering it, your value per share would have been closer to $50 per share. So with both expected share count and options, rather than try to adjust the number of shares outstanding, I'm either adjusting in the case of the dilution through the cash flows or by explicitly valuing the options and netting them out. Any questions about either the dilution story or the options? Now, when I valued Amazon and had those negative cash flows, I also told you I'm implicitly assuming that the company will be able to raise capital and keep going. And I threw open the possibilities. What if that doesn't happen? And the answer there is, if we cannot come up with that capital, the company will not make it. So I'm going to start with a graph that is actually an empirical graph. I think it's the Bureau of Labor Statistics in the US keeps track of the number of startups by sector and tracks how many of them make it through year 1, year 2, year 3. So let's say, and so let's take natural resource companies. For every 100 companies that get started, only 81 make it through year 1. So that's what you can read as the 81%. In fact, if you go all the way through year 10, out of every 100 startups in natural resources, about 35 survive through year 10. And you can see it varies slightly across sectors. This is from a very old study. I was able to find a slightly more updated study. But basically, this then tells you that in many businesses, most startups don't make it. So when I do that 10-year forecast, especially if it's a young company, what I'm missing is the fact that a lot of these companies will not make it. So let's assume in the case of Amazon, January 2000, I came up with the value of $35 per share. Let's say there was still a 10% chance that Amazon would not be able to raise the capital. It's not an implausible number. What do you think your equity is going to be worth if they're unable to raise the capital? Maybe not zero, but definitely not $35 and something, right? Maybe $5, maybe $7. So in statistics, if I told you there were two scenarios, one in which you survive and you're worth 35, and the other in which you are forced to liquidate and you make 5, what do? We take the expected value, probability of survival. I don't know why we don't do this more often in valuation. Bring in an explicit likelihood of something bad happening, come up with an estimated value, and come up with this value across all possible scenarios. So I finished my Amazon valuation, 35, stocks trading at 84. And one of the people in the audience says, and she must have been somebody who owned Amazon, she said, is it possible that Amazon is worth $84 per share? What's the answer to that question? Is it possible? Possible is such a weak word. Of course it's possible. But this is, I think, the best way to deal with somebody saying, is it possible that Tesla is worth $1,300 per share? Is it possible that Rivian is worth $80 billion? Of course it's possible. In fact, with the framework we've set up, we know the two variables that pretty much drive value. It's your revenue growth and your margin. Even your sales capital is not a big player. Revenue growth and margins. If I use a higher revenue growth, my company will get bigger. And if I use a higher margin, I'll get more profit. So here's the way I answer that question. I said, let's try different revenue growth. If you remember, I'd used a 42% compounded growth. I let the growth rate go up as high as 60%. In my base case, I used a 10% margin. I said, what if we're at 12 or 10, 14%? And I estimated the value per share with all those combinations. This is a break-even table. You might have seen break-even charts, but they often focus on one variable. And I think they missed the point because growth and margins are kind of twinned. You want to look at them together. You're saying, what are the shaded boxes? You know what the shaded boxes are? What's the stock price? 84. Those are the boxes where the value is higher than the price. There's a book called Expectations Investing. If any of you get a chance to get your hands on the book, read it. Now, normally when we do valuation, what we do is value the company and there's a price. We compare the value to the price to make our judgment. Expectations investing, instead of doing that, you take the price and you back out of the price what the implied growth rate. The problem is you can pick one variable and solve for it, right? So if you take a spreadsheet and say, I've come up with this, the stock price is 80, what would the growth rate need to be? So you can use the solver function to say what's the expectation investing says, for this stock price to exist, your growth rate has to be 30% a year. You're saying, what do I do with that? You as an investor can then say, is that a reasonable growth rate? Or is that a reasonable margin? It's not as if you're doing something different, you're just reframing the question. So in this case, I could tell you the break-even points. So in short, if Amazon can grow like Walmart and have margins like Ann Taylor, then I can justify the price with 60% growth. And then the question you got to ask is that a viable combination? It's a different way of framing exactly what I said with my valuation. So with that long lead in, may give you some consolation price. Many of you valuing young companies, you're going to come up with a value. And I told you this last session, and I'll tell it again, you are going to be wrong 100% of the time. But I also said, and I'm going to put some flesh on this, that you don't have to be right to make money. You just have to be less wrong than everybody else, right? Now, I've been valuing Amazon every year since 1997. So I'm going to take you through a period, 2001 through 2004, and show you how this played out. So I started my 2000 valuation. You saw my valuation, right? The value was 35, the stock was 84. And I did the little song and dance about why I couldn't sell short. And let's say I got away with it. Incidentally, if I'd been able to sell short, I'd have made a lot of money because in the next year, the dot-com boom bust. And I revalued Amazon 12 months later. Saying, what can happen in 12 months? With young companies, lots can happen in 12 months. In this case, the economy had gone into a recession, dot-com boom had bust. I revalued the company and my value went from $35 to about $20 per share. I actually did another presentation to the CFAs. And the first question I was asked was, aren't you uncomfortable that your value changed that much? To which my reaction was, after the last year, I'd be uncomfortable if my value didn't change at least that much. The world has shifted under me. And if you think I've changed my mind going from $35 to $21, how do you describe what the market did? Because the market went from $84 per share to $11 per share. Stock went from being dramatically overvalued to significantly undervalued. And I was trapped. You know what I mean by trapped? Last year, I would use that excuse of I can't sell short. Now I'm out of excuses, right? If the stock is valued at 20, the stock is trading at 11, I should be willing to buy. First time I ever bought Amazon was in January 2001. Those of you who follow value investing, one of the pieces of advice you often get from old-time value investors is if you find a good company, buy it, and then do what? Just hold it forever, which makes absolutely no sense to me if you're a value investor. And here's why. What's the essence of value investing? You buy when the price is much lower than your value, right? And if you stay true to that notion, how the heck do you hold this forever? What if the price goes up 100% tomorrow and the stock goes from being massively undervalued to massively overvalued? So if your belief is you should buy things when they're undervalued, then the consistent thing to do is you got to sell those things when they become overvalued. What I've essentially done is if you buy these companies, it's not a one and done. You got to revisit the company because you can't use the old valuation from 2000 to, every consecutive year. I've had to value Amazon every year. So in 2002, when I revalued them, my value went up. It had been a decent year, but the price also went up. It was still undervalued. So it stays in my portfolio. 2003 was an incredibly good year for Amazon. My value reflected was up about 80%, but the price almost tripled. My first buy of Amazon, my first sell of Amazon. Now do you see why with companies, if you value a company that you've been intrigued by, and you find it overvalued in May of 2022 when you do this project, don't throw it away saying that was a waste of time. You've done the homework for building this valuation. Come back to it a year from now, 6 months from now, 2 years from now, because what looks overvalued today could become undervalued tomorrow. With Amazon, it's a company I kept revisiting and revisiting. In fact, in 2014, I did something I usually don't do because it's kind of depressing to see how wrong you were on a company. So in 2014, I went back to my 2000 valuation of Amazon. Remember those projections I gave for Amazon? I compared those projections to the actual numbers to see how close or how far away I was from the actual numbers. So let me show you what my projections were for revenues. Those are my projected revenues in 2000. So you go back and look at my DCF valuation. Those were my projected revenues. Those were the actual revenues. In fact, as you go through time, you can see the numbers diverge. Early on, I overestimated how much they could have as revenues. Later on, they shot through the roof. In fact, by the time you get to 2014, my projected revenues for Amazon were $51.4 billion. They actually had revenues of $85 billion. Why? Because they'd gone out of retailing into other businesses, something I did not forecast in 2000. That's the good news. Here's the bad news. In my original valuation, look at what happens to my profits. As margins improve, profits go up, right? In actuality, that's what actually happened to the profits. Initially, they actually were looking like they were moving towards improving margins. But somewhere around 2010, they seemed to go in the wrong direction. In fact, in 2014, they were basically making nothing. So whatever I learned about Amazon between 2000 and 2014, they can grow far faster than I thought they could, but they're going to have a much tougher time delivering on profits. But also, it was quite clear that they were no longer just a retail business. So in 2012 or 13, I made a transition in my Amazon story. Story for Amazon I've been telling for the bulk of the first decade is it's a retail company. And as it grows, it's going to find a way to make profits as a retail company and deliver. And the new story that I told is a story that I still build off when I look at Amazon. To me, somewhere between 2010 and 2012, Amazon made the conscious decision to change from being a retail-focused business to a disruption machine. Let me explain the basis for the story. The way I see Amazon now is they will be in any business they choose to be. If they find there's softness in the business, they can exploit, and they can come in and take advantage of the status quo. In fact, I remember reading a survey, this was about 4 or 5 years ago, where in the survey, the CEOs of the 50 largest companies in the world were asked who their 5 biggest potential competitors would be going forward. 50 very diverse companies ranging from JP Morgan all the way to, to Disney. 47 out of the 50 companies listed Amazon as one of their potential competitors. Walmart, obviously, right? Amazon lives in its head. Of course, it's part of it. We worry about it all the time. FedEx, 2005. Yes, FedEx, do you worry about it? Why would you worry about Amazon? Today, Amazon is a bigger logistics company than either FedEx or UPS. Disney, 15 years ago, said, what's Amazon going to do to us? Now, if you look at content investment, Amazon Media is a big player in the entertainment business. You think, why would JP Morgan list Amazon as a potential competitor? What did I say Amazon does as a disruption? It targets fat, inefficient businesses where the status quo is really lazy and caught in its ways, and it goes after it, right? That is a perfect description of the financial services business. Insanely big, horribly inefficient, and existing practices just get nailed in because that's the way it's always been. It's a disruption machine. You know how difficult it is to value a disruption machine? Because remember we said first step in valuation is to say what the potential total market is. If you're a car company, it can be what, 80 million cars, and you target for that. If you're a disruption machine, what is your potential end game? You can be in any business you want, right? You can have revenues of multiple $1 trillion. It opens the process up where Amazon can keep finding growth. Why? Because it never runs out of growth. It just finds a new business. And along the way, it has this incredible asset. It has a disruption army. You know what I'm talking about? How many of you are Amazon Prime members? Look around, right? And you shouldn't be surprised. There are, and some of you live on your parents' Prime. I kind of know that. So I assume that when you put up your Prime, that you're in somebody's Prime membership. 130 million people have Amazon Prime. You know why I call them Amazon's disruption army? Remember when Amazon bought Whole Foods? The day after they bought Whole Foods, I got an email, and I wasn't special. There were 100 million people like me who got emails, all Prime members. And here's what the email, I saved the email because in a sense, it cuts to the heart of how Amazon approaches disrupting a business. They said, we've just bought a Whole Foods in your location. Would you be interested in getting frozen dinners delivered to you as a Prime member? You know, the day that Amazon bought Whole Foods, Blue Apron lost 70% of its market value. If you don't know what Blue Apron does, go to Google search, look it up. It basically delivers pre-refrigerated meals that they did. Every time Amazon enters a new business, they've got this army primed to go. And why is the army so willing to listen to Amazon? I don't know about you now, but if I want something delivered tomorrow, I'm ordering on Amazon, no matter what the other promises are. No matter what you think about Jeff Bezos and Amazon, there are things where you trust Amazon because they've delivered. It's a disruption army. You know what the only thing that can stop Amazon is? I don't think there's a company in the world that can go head to head with Amazon and win. Because Amazon has patience built into its DNA. It will outlast any company. But everybody hates Amazon, especially in the business space. Why? Because they know that Amazon is coming after their business. The one thing that can stop Amazon is government and regulation. And every competitor will shed crocodile tears about how terrible it is that the government is stepping into free enterprise, but they're all cheering in their office rooms. So finally, we have a force that can bring Amazon down. But it's not going to be easy. Because governments talk about it, we'll stop Amazon. You know why it's not going to be easy? The weapon they're going to use is antitrust law, right? And antitrust law, when applied, was popular especially in the 1900s. Why? Because it stopped monopolies. And you know why people liked it when monopolies were stopped? Because monopolies ripped off people. They charged you a really high price, and antitrust law said, we'll protect you from Standard Oil charging you 20% more on gas. Do you feel ripped off on any of your Amazon interactions? But at Amazon Prime, terrible deal, right? At 119, how dare they charge? You could probably add a 0 to it, and I'd still be a Prime member. Nobody's complaining that you're not getting enough value for your money on Prime, right? With Prime, not only do you get free shipping, you also get this free Amazon media and movies. I mean, this is the best bargain on the face of the earth. And what's the government going to say? We're going to protect you from that bargain. Can you imagine if the government said, what Amazon is doing is not right. They're charging too little for Prime. We're going to ask them to charge at least 500. No government would ever get reelected. There are 120 million people voting against you right off the top. You took my Prime away. It's not going to be easy. That's why with all this talk of regulation, if you're wondering why very little seems to be happening, it's not going to be popular to go after a company like Amazon because their mistake is they've given away stuff for too little. It's a disruption machine. The value is expanded because of the disruption machine. It makes it more difficult, more of a challenge of a company to value. And in September of 2020, about 6 months into COVID, I valued Amazon again. Because during COVID, those 6 stocks, Facebook, they're all gone up. So I wanted to see whether they'd gone up too much. At that time, I got a value of $2,827 per share for Amazon. The stock was trading at about it was within 7%. If any of you read my Fangam post from 6 weeks ago, I valued Amazon again. And for the first time in about 8 years, Amazon actually looks undervalued or looked undervalued. So if you get a chance, go back and look at it because you're going to see my story expand over time as the company has changed. So that's young companies. If any of you are valuing young companies, don't be too hard on yourselves in terms of how do I know I'm right? Because nobody does. You got to make your best estimate and move on. But make your story internally consistent, whatever story you're telling about the company, and be willing to revisit that story. Even during the course of the rest of the semester, things can happen that can change your story. Let's move to the second set of companies in the dark side. Usually mature companies are easy to value. Why? Because they're set in their ways. They do the same thing over and over again. Like we all do, right? You probably wake up around the same time every day. I don't know about you, but many of us wake up around the same time every day. We do the same sequence of things in the morning. We go to the same coffee shop. We get the same size latte or the same size cappuccino every day. We take the same path to school. Why? Because that's what human beings do. There's some comfort in doing. But are some of the things we do every day kind of inefficient or even bad for us? That bag of potato chips you open at 9 p.m. every day, that's not probably a great idea, but you do it because that's what or the Talenti ice cream, you say, it's 6 servings. It never is 6 servings. It's like 1 serving, you eat the whole thing. So, but that's part of your sequence. You finish a whole carton every day. This is going to connect to mature companies. Mature companies are set in their ways. They do the same thing over and over because it worked for them in the past. But could some of those things not make sense anymore? Absolutely. There are many mature companies that are doing things. Blockbuster kept opening new stores well after people stopped coming into Blockbuster stores to rent videos because that's what they'd been doing for a long time. Companies get into bad habits. And when they get in bad habits, you get activist investors targeting them, so you need to change. And when you have a company, a mature company that's being targeted for change, it becomes a little messy. And here's why. Remember those 4 questions I said you need to ask and answer? What are the cash flows from existing assets? What's the value of growth? How risky are you? When will you be a mature company? The answers to those questions can be very different if the company stays doing what it's doing, or it decides to change to reflect the push from the outside. In other words, you can get two sets of answers. And trying to put both sets of answers into the same valuation is really difficult to do. So the right thing for Kohl's to do is actually shut down stores because the stores are not making money. You can't value Kohl's with both increasing stores and you're asked to make a choice. And my advice to you is don't make a choice. Why don't you let both ways play out? Okay? Rather than be mysterious, I'm going to pick a company. What are Hormel Foods? It's got this very famous or infamous product. Perhaps the most disgusting thing ever made as food in the history of mankind. You know what I'm talking about? Spam. Have you ever seen spam? All you need to do is see it and you'll throw up. It's like this slimy looking ham in a can with a life that exceeds 2 nuclear wars, I think. You can keep it in your cupboard for 50 years and put it. How you put meat in a can and it lasts for 50 years, I don't even want to know. But there are parts of the world where spam is actually very popular, like Hawaii. You know why spam is popular in Hawaii? Anybody know the history of Hawaii and ham? I'm sorry, spam. At the end of the Second World War, the US Army was trying to get its soldiers back from Japan, from the Asian war front. And getting from Japan to the West Coast of the US, it's a really long flight. And none of the military aircraft the US owned then had enough capacity to go all the way. So they had to make an intermediate stop in the middle of the Pacific. And what's the only place in the middle of the Pacific you can stop is Hawaii. So you have tens of thousands of hungry soldiers arriving in Hawaii. And these were not vegan soldiers, right? They wanted meat. And the US Army put out an all point, there's not enough meat in Hawaii to feed 3 soldiers, let alone thousands and thousands. So US Army said, no, we need some way to get meat to Hawaii, and we need a way to get it in a way that it will survive and stay, and we don't have enough refrigeration to refrigerate. So Hormel invented spam for the US Army, and it stayed on. With that long lead in, let's talk about Hormel today. It's actually from a few years ago. Hormel used to be a family-run company, but that's almost a century ago. The family's kind of moved on. It's now a company run by managers who are very conservative. Let me explain what I mean by very conservative. I'm not talking about political conservative. I'm talking about economically conservative. They didn't believe in global growth. They were a very US-based company, so they reinvested to grow just in the US. The reinvestment rate was low, the growth rate was low. They also were a company that didn't believe in the use of debt. Why? Because debt is dangerous. They used very little debt. So they had a debt ratio of about 10%. And because they reinvested so little, their growth rate was about 2.75%. But there was some talk about maybe the company needs to change. So here's what I did. I first valued Hormel with the status quo, with the low growth rate and the low debt ratio. And the value per share that I got was about $32 per share. So traditional DCF valuation. And then I said, what if somebody else ran the company, or this company was run differently? With 2 changes. One is, what if it goes more aggressively for global growth? What does that mean? A higher reinvestment rate and a higher growth rate. So instead of the 2.75% growth, then I'm not going to go crazy and give them 50% growth, 5.6% growth. And what if they were a little more willing to use debt? Because debt can lower your cost of capital, especially with the tax advantage. And I used a 40% debt ratio. And I'll talk about why 40%. I didn't arbitrarily pick that number. That lowered my cost of capital, increased growth rate. The value per share that I got was about $38 per share. So I have 2 values, 32 and 38. The stock was actually trading at about $33 per share. You see the quandary I'm in? Because if I compare the 33 to the 32, it looks slightly overvalued, but 33 to the 38, it looks undervalued. Saying which one can I use? Neither one is functional because they're both under different scenarios. So I estimated the probability that Hormel would actually change. Now it's tricky. You're saying, how do you come up with that number? It's looking at the facts on the ground. Now, what allows for change? Investors are able to put pressure on the company to change by buying shares and getting enough shareholders to vote with them. So the place I went and looked at the top 20 shareholders in Hormel. I wanted to see who was in that list. Were they the kind of investors you could put pressure on and get on your side or not? The largest single shareholder in Hormel was the Hormel Foundation. The family that used to run Hormel had taken their wealth and put into a foundation, 23%. So I want to know who ran the Hormel Foundation. If I could just get that guy on my side, I could get the CEO to kind of change his ways. So I looked to see who ran the Hormel Foundation. The chair of the Hormel Foundation was Hormel's CEO. This is going to be really difficult. Say, hey, can you put pressure on yourself? It's not going to work. What does that mean? The likelihood of change here is small because of the way the company is structured and the shareholding. There's only a 10% chance, and even that's probably being a little optimistic. And the only reason I even said it as high as 10%, the same thing used to be true at the Hershey Foundation and with Hershey's. But there, eventually, the family essentially said, we're leaving too much money on the table, we have to change. So the 10% reflects that possibility. So 10% times 38, 90% times 32 gives me an expected value of $32.50. Stock is pretty close to fairly value. But there's a new story that can show up tomorrow that can dramatically change my answer. What will that new story have to say? What if it says Carl Icahn has just taken a position in Hormel? Now, you might think whatever you want about Carl Icahn, but basically that's shaking up these probabilities, right? The day after an activist investor like a Bill Ackman or a Carl Icahn shows up, what happens? The likelihood of change doesn't become 100%, but it goes up from 10 to maybe 30%. Think of what the expected value will be if you make it 30 and 70, 30% probability. That's why activist investors can affect value, because they affect the likelihood of change in a company, and by affecting the likelihood, they can affect the expected value. So if any of you are valuing companies and an activist investor pops up between now and May, the price is obviously going to affect it, but your value could also change if you can think about these two possible scenarios which can occur. Now, staying on the point about mature companies. Anytime you see a mature company target and there's a restructuring in a mature company, you hear talk of cost savings. We're going to save $3 billion in cost, $5 billion. You know that 90% of the time, the cost savings that are stated upfront never get delivered. So we react to the cost saving. That's amazing. Why? Because there's no buy-in. Management talks the talk, but they don't want to walk the walk. They cut the easy cost. Like what? I give you 3 janitors, let's go to 2. That's a big saving right there. But if 3 managing directors going to 2, that's too painful. Let's not do that. So McKinsey actually did a survey to see what has to be true. So I'm not saying anything in the survey is going to change your mind, but basically don't take cost savings that are reported as facts, because often I've seen people value companies, they push the margin up to reflect the entire cost set. Say, do you really want to do that? Because that's not the history of cost savings at companies.
What if it's like a company like that's being acquired by the financial?
Because somebody else will do the cost savings then, right? Then you can pretty much count on the cost savings, because KKR is buying you. Yeah, they don't care that you have 2 managing directors. They don't care that you are a managing director who's lost your job. But remember, in most companies, cost savings have to come from within. You don't have an outsider doing it. Second point, and I'm sorry?
Private equity is expensive.
Private equity, that's part of the reason, because an outsider coming in is more likely to cut those costs than an insider doing it, because they have less to lose. Right? Second lesson, and this is actually, you've seen the updated version. Many mature companies have low growth, right? So what's your reaction? Grow faster, but be careful what you wish for. Why? Because remember, you can grow faster and destroy value. And in fact, you've seen this updated version of the graph. 59 to 60% of global companies earn less than their cost of capital. In the case of Hormel, I want them to grow faster. Why? Because they're earning more than their cost of capital. But if you gave me a mature company that's earning less than its cost of capital, growing slower might actually increase your value. Not growing faster, shrinking might be a best choice. And finally, Remember the debt ratio that I picked was 40%. You're saying, why 40%? The answer usually is higher debt ratios, lower cost of capital. That is actually not true. It's absolutely not true. Because if that were the case, every company should be at 99% debt. In my corporate finance class, which I haven't had a chance to teach at the undergraduate level for a long time, we go through this process of optimizing capital structure. Sounds fancy, but here's what I do. I actually compute the cost of capital at every debt ratio. And the way you can do that is, remember, my cost of equity comes from a beta, but it's a levered beta. So if I go to a higher debt ratio, I recompute the beta, come up with a higher cost of equity. The cost of debt comes from a rating, but if I change my debt ratio, that rating is no longer functional. I compute a synthetic rating based on your interest coverage ratio. So I'm drawing on tools we've already used in this class. And what it allows me to do is compute the cost of capital as a function of the debt ratio. So with Hormel, they're right now at 10.39% debt. That's the cost of capital. It is true that as they push up the debt ratio, initially the cost of capital continues to drop. In fact, between 30 and 40%, it kind of, I think the optimal turns out to be like 38%, if you work through the individual. But once you get past 40%, look at what happens to cost of capital. It starts to go up again. I didn't arbitrarily choose the 40%. I chose it not because it's an industry average, but because it's where my cost of capital is minimized. Which brings me to my last piece of the life cycle. We've talked about young companies, we've talked about mature companies, let's talk about declining companies. How will you know you're dealing with a declining company? When you look at the last 5 years of numbers, your revenues are actually getting lower over time. When you look at your margins, they started at 16%, they're sliding down. It's not pretty, right? But it is what it is. Your company is declining. And if you're valuing a declining company, what's a sensible thing to do? And ask you, what's your revenue growth rate going forward? If the seeds of the decline have not gone away, what should you expect to see as revenue growth in the future? It can be negative, right? Let me ask you a question. How many of you are using negative revenue growth rates for the next 5 years? The spreadsheet, you are. And that's actually uncommon, right? Because I've actually asked this question of people who've been doing DCF valuations for 40 years. I say, when was the last time you valued a company with negative? There are lots of people who've been valuing companies for all of their lives who've never put in a negative revenue growth rate. And they say, how does that even make sense? Because in the real world, do companies shrink? Absolutely. How come you never encounter one of these companies? The answer is they do, but they override the negative because it makes them feel uncomfortable. Let's be honest. Putting in a negative revenue growth rate feels unnatural. As human beings, we're almost hardwired to be upbeat and optimistic. And putting this seems like depressing to begin with. So what do? You go, I'm not going to put the minus, I'll put the plus. I'll make it a really small number, but it'll still be positive. But if you have a shrinking company, the revenue growth rate, in many of your companies, I ask you to pick a target margin. And I could ask this question again, but I want to look inward. How many of you picked a target margin higher than the current margin? And how many lower? I'd assume that it's 80-20, 80% pick higher margins. Again, not because most companies have increasing margins, but again, because as human beings, we're kind of hardwired for this optimism. The reality is when you value young companies and ask the question, what are your cash flows from existing assets? They're often negative and shrinking. When I ask you, what's the value of future growth? You're saying, what future growth? There's none left. So how risky are you? Your business is shifting because you're shrinking as a business. Some of your businesses are going away. And if you're not careful and you have a lot of debt, I worry about you not making it. And when I ask you, when will you be a mature company? You start laughing. You say, that was 10 years ago. I was in a retirement home yesterday visiting somebody. If I went and said, when will you be middle-aged? I'd probably be slapped down with a cane. Because when you're 81 years old, when will you be middle-aged? It's looking backwards, it's not looking forward. Many of you are valuing 81-year-old companies. Don't make them middle-aged on your spreadsheet. It may make you feel better, but it's not going to really happen. So let's talk about valuing declining companies and what to do. Be real, right? If you have a company in a shrinking business, let your revenue growth be negative. Let your margins decline over time. In fact, the worst thing that can happen to you as an investor in these companies is these companies are run by managers who fight the natural aging. What are they going to do? They're going to go do acquisitions. With acquisitions, you can always make your revenues grow. It's like facelifts, right? You basically do a face, it doesn't work. You essentially are going to throw money, good money away after, bad money away after good money. So I'm going to show you valuation of a company where I had to take like 5 showers during the valuation because I felt filthy valuing the company. No, don't worry, it's not some, no, not Pornhub or something like that. No. It was JCPenney. It was about 8 years ago. JCPenney, if you think about the story you're telling, it's closer to a horror story than a happy story, right? There was no good ending that you could see in the company. So I sat down to value the company and I said, here's the best case story I can tell. It's a story where they're going to shrink over time. By doing what? By shutting stores that no longer work. But here's the optimistic part of the story. I assume that there's a piece of JCPenney that can survive. Maybe half of its existing size, maybe stores in big malls or stores in very. So in this story, here's what you see. You see revenue growth. It's a negative number. My revenues actually go from 12.5 billion down to 10.5 billion. My margins actually kind of improve because the remain. So what they're doing is they're shutting their least profitable stores and moving in. It's an upbeat story, as upbeat as you can get with JCPenney, but you can see negative revenue growth, making the company smaller, improving margins, and an end game where there's a core of the company that can continue. What if that's not true, though? What if you're valuing Bed Bath and Beyond? And you think the best case scenario is you run the company to the ground, shut down 10 stores every year. The end of the 10th year, there's nothing left. You know what you should do then? Have 10 years of negative revenue growth. And the end of the 10th year, what the heck are you doing estimating a terminal value with the 2% growth forever? Put in a liquidation value where you essentially take whatever real estate is left in the company and tie things up. If you have declining companies, you got to break the mold. You got to think of it more like a project than a company, because perpetual life might be not even on the top 50 things of what you can do with this company. But things get worse if you have a declining company with a lot of debt. Or even a growing company with a lot of debt, because what you worry about is this company might not make it. And I told you at the start of this class, if you do a traditional DCF valuation of this company, you will almost always overvalue distressed companies. Because you're building in the assumption the company will make it back to health. And we know empirically that's not true. A lot of companies with a lot of debt and distress don't make it. So here's what you need to do. Put your optimist hat on, value the company. With the optimist hat on, you're going to assume that the company can make it. Build it in your spreadsheet, right? Margins come back, debt ratio comes down, company becomes healthy, you get a terminal value, get a present value. But then don't stop there. Take the optimist hat off, put your realist hat on. So what is the chance my company will not make? And we'll talk about ways you can estimate that. And then ask yourself, what will happen if they don't make it? You're saying, what do you mean? You're an equity investor. What do you care about? They don't make it. What can they sell their assets for? And what can I collect as an equity investor? So I'm going to use a company to illustrate this process. Heard of Las Vegas Sands? It's a casino company. And I'll make a couple of statements about casino companies, and I think you can back up these statements. First, casino companies are big infrastructure investment companies. You drive by, you're driven by a Vegas casino, this is like a monstrosity. I remember I had to be at the Bellagio for some session. I think I got lost like 15 times in the 2 days that I was there. It's got like 26 restaurants. You go down the wrong corridor. Nobody might find you for like 3 or 5 years. It leads to nowhere. So huge infrastructure investments. Second, and maybe I shouldn't generalize, but I will. Most casino companies seem to be run by megalomaniacs. There's something about casino companies and megalomania that go together. So I'm going to make this real. Las Vegas Sands, it's a casino company, is a company that grew dramatically between 2000 and 2007. They started off as a Vegas-based casino company, then they built a casino in Macau, casino in the south. They actually built Marina Bay Sands in Singapore. There's like a gigantic boat on top of this 50-story building or 30-story building. All extraordinarily expensive investments. And Las Vegas Sands was run by a man called Sheldon Adelson. He died like 2 years ago. And he owned 51.7% or 52% of the shares in Las Vegas Sands. This is relevant. Why I put in the 52%. And normally, if you have $1 billion casino to build, there are two ways you can raise money to fund the casino, right? You can borrow money or you can issue shares. And Las Vegas Sands borrowed almost every single dollar they need to build the casinos. You're saying why? If you own 51% or 52% of the shares and you're a megalomaniac who wants complete control, you see why you don't want to issue shares? Because you issue shares, the 51% might become 49 or 48 or 47. So this was deliberate. They grew primarily with debt. And when times were good, this was amazing. It worked out in your favor. It was one of the most highly recommended stocks on Wall Street. And then 2008 happened. 2008 knocked the bottom out of the economy. People stopped coming to casinos. And the second thing that happened was the debt markets froze, right? Because the default risk climbing, spreads were wide. And this was a valuation I did of Las Vegas Sands in February of 2009. It's a troubled company, rumors floating around that they might not make it through the next 6 months. I put my optimist hat on and I've fixed every problem. It's so easy to fix troubled companies on spreadsheets, right? You make the minus into plus, the revenue grows, the debt rate. I mean, it's like playing a game. You're sitting there fixing everything. You're like a private equity investor. Everything's gone, solved in 5 minutes. I solved every problem the company had. I came up with the value per share based on fixing every problem of $8.12. Stock price was $4.25. Remember doing this valuation in Vegas in February 2009. And somebody asked me, are you buying the stock? And I said, no. And they said, that doesn't make sense. You came up with a value of 812 and stock. And I said, you're absolutely right. But the $8.12 is the value for Las Vegas Sands if it makes it, right? And all these rumors swirling around me, what are they saying? It might not make it, it might not make it. And that's not in this valuation yet. You're saying, why couldn't you increase your cost of capital? It doesn't work. Costs of capital are blunt instruments. You can't raise them enough to cover this kind of risk. So I said, I need to assess the likelihood that Las Vegas Sands will not make it. This is that failure probability I ask you in the spreadsheet. And you say, what the heck do I use to come up with it? I'll give you the easiest scenario. If your company has a bond rating from Moody's or S&P's, you just got lucky. You know why? Because we have a history of bond ratings going back 100 years and what percentage of bonds within each ratings class fail within 10 years. Now, Ed Altman, who used to teach, and he might still teach a class or two. Now, Altman Z-score, I'm sure. Ed's been updating this table pretty much every year for the last 40 years. He takes bonds that were outstanding in 2012, based them on ratings, and look at what percentage of bonds within each ratings class fail within 10 years. So we look at AAA rated bonds, for instance, 0.18% of bonds that were AAA in 2012 failed by 2022. But if you look at triple B, it's like 11%. Look at triple C, it's like 51%. You see how this is going to help you? If you have a bond rating for your company, there's a lookup table you can use it. In fact, it's on my website. I'll send you the link if you want, where you can say, my company has a bond rating, I can look up the failure probability. But the problem is you're trusting the ratings. Here's the other alternative. If your company has bonds outstanding, there might be a way in which you can use those bond prices to extract the likelihood that your company will not make it. Let me explain. Las Vegas Sands had a 7-year bond outstanding. Bonds usually have a par value of 1,000. Usually when they're issued at 1,000. This bond was trading at $529. Now, normally the way we're taught in fixed income to price a bond is you take the promised coupons and face value and we discount them back at this risk-adjusted rate. I'm not going to do that. Here's what I'm going to do instead. I'm going to take the promised coupons and convert them into expected coupons. You're saying, what does that mean? Well, to get the coupon, what has to be true? The company's got to be around, right? So I took each coupon and multiplied it by the probability that your company was around. You're saying, how do you know that? I don't. I'm going to set it up as the X variable. But if I'm adjusting my coupons for risk, I can discount them back at a risk-free rate. So here's what I know. I know the price of the bond. I know the promised coupons. I know the risk-free rate. I solved, and this is the great thing about having the solver function in Excel, for the likelihood that the company would not make it. And it was terrifying. Based on what the bond market was telling me, it was saying there's a 77% chance your company will not make it through year 10. What's so magical about year 10? That's why Nirvana is hanging out for me, right? I'm never going to get to terminal value. My $8.12 value is the value the 23% of the time my company makes it. The remaining 77% of the time, my equity is going to be worth nothing, because think about liquidating a casino company and paying off all the debt. I can guarantee you there's going to be nothing left over for the equity investors. So when you're thinking about distressed companies, factor that in. But it's not just distressed companies. I'm going to leave you with the valuation of Boeing I did on March 23rd of 2020. It's like the peak COVID panic. Everybody's selling everything. Normally, you don't think of Boeing as potentially going bankrupt, right? But there was talk on March 23rd that they might not make it. Why? The airlines were all grounded. You're not selling aircraft, all these fixed costs. So I did a traditional DCF valuation. And because I had that failure probability built in, I was able to adjust it for the fact that I'm scared. I'm scared that Boeing will not make it. During crises, that failure probability is going to go up across the board for all companies. So use it as your mechanism for worrying about what are the risks I cannot capture in a DCF? How do I bring that in? Bring it in through a failure probability. And you can say my equity can be is worth nothing or half of what it should be worth. You can make judgments about what it's worth. But I think it's the most effective way of bringing in this discrete risk, potentially truncation risk. So I'm going to stop there, and next session, we're going to talk about emerging market valuations. But before we do that, there will be the quiz.
Some two questions. First one is if you do non-controlling interest, I get one from the stockholders' equity and multiply it by the price of book. That's it. Okay, this always. And then when counting shares outstanding,
You don't subtract from net income.
from my,
You don't subtract from net income, you subtract from value back.
okay. And then when I'm doing the shares outstanding, I do RSUs, all of them.
Yeah.
And just the values of all these two together, right?
Yeah.
Plus the shares outstanding, or just these?
Oh, you have to include the shares.
Ah, so you add these, and you don't put options.
No.
Okay.
Options have to be.
And what is recourse? Is it interest bearing? Okay. And also, I'm probably going to do Ecolabs. I'm in between Ecolabs and those. When doing dividends,
Yeah.
how do I take it into account for my model? Because it has like a certain percent of dividends, like 0.7.
Doesn't matter. You can't
Doesn't
count
matter?
both the value of the holding and the dividends from the
Oh, so
holding.
you just
They double
ignore it.
count. You do one or the other. You
I
can't do
just
both.
ignore it. Okay. All right. And